The global energy map just got shredded, and your portfolio is staring down a massive black hole that could swallow your gains whole. Let's see where the smart money is flowing today as we dive into destroyed oil infrastructure and which ASX stocks are actually winning. G'day, Gain Squad. Today we are tracking the massive Middle East supply shock, the chaos in the Strait of Hormuz, and gold's wild price floor. We are talking about 17 million barrels of oil, effectively trapped while a world-class safe haven, gold is shaking with volatility. We are also doing a deep dive into the technical indicators for gold to see if we can optimize this entry before the next breakout. This script is for entertainment and education only, so please don't go betting your house without talking to a real financial professional first. So, smart money, here is the big question. Is this $90 oil price a temporary spike or the start of a multi-year energy tax? Drop your thoughts in the comments, hit that like button, and subscribe to Goldie Gains so you never miss a golden opportunity. Now, let's get into today's top stories, because the news coming out of the Middle East between April 21st and 23rd is absolutely mental. We have entered the 8th week of the conflict, and despite President Donald Trump extending the ceasefire, the energy world is in a proper tiz. On Wednesday, April 22nd, Trump announced an indefinite extension of the truce with Iran to allow more time for diplomatic talks. While that sounds like good news, the market's having a bit of a wobbler because the Strait of Hormuz is still effectively closed to shipping. That narrow waterway is the world's main oil artery, and right now it is blocked tighter than Sydney traffic on a Friday afternoon. Only 16 ships managed to transit the strait on Monday, which is a massive drop from the usual 50 vessels we see daily. This bottleneck has left approximately 17 million barrels per day of crude and refined products, totally stuck with nowhere to go. Even with the ceasefire, the US Navy is still intercepting vessels, and Iran is refusing to budge until the naval blockade is lifted. The supply gap is so massive that experts estimate about 10% of the entire global oil production is currently offline or impaired. Peace talks in Islamabad actually fell apart on Wednesday because the crew from Tehran decided not to even show up to the meeting. This means the war premium is staying baked into every barrel of oil, making life very expensive for anyone who likes to drive. Analysts are warning that for every day this standoff continues, another $4 to $10 is added to the price of a barrel. We are looking at a global stress test where even a partial disruption of 20% can send the whole economic system into a spin. Citi has already come out and warned that if the strait remains closed for another month, we could see oil hitting $110. Some are even more bearish, with BlackRock's Larry Fink suggesting a global recession if we see years of $150 oil. This isn't just a local disturbance. It is a full-blown energy crisis that is redefining how we look at supply and demand in 2026. Let's talk about the infrastructure, because the war has caused some serious damage that won't be fixed with just a bit of duct tape. Reports indicate that several key refining facilities and export terminals in the region have taken direct hits during the early weeks of fighting. Bringing that capacity back online is not going to happen overnight, with engineers estimating a timeline of months or even years for repairs. Even if the war ended tomorrow, the backlog of tankers and the damage to the pipelines would keep the supply chain under massive pressure. We have to consider the adverse scenario, where oil prices stay elevated for years because the structural supply from the Middle East is gone. The global market is currently short about 12 million barrels of crude oil per day, compared to where we were before the war started. This is forcing every country on the planet to scramble for energy security and look for producers that aren't in the middle of a conflict. For our ASX-listed companies, this higher-for-longer oil price environment is actually creating a massive windfall for some local heroes. Smart money is moving into the ASX energy sector, which has already seen gains of over 10% in the last month alone. One of the biggest beneficiaries is Ampol, ticker ALD, which rose nearly 4% on Wednesday as local fuel demand stays robust. As a major fuel refiner and distributor, Ampol is sitting pretty as they pass through those higher costs to the bowser while maintaining margins. Then you have AGL Energy, which surged over 11% this week because everyone is waking up to the need for local power. AGL is a key player in keeping the lights on in Australia, and their stock is being treated like a defensive vault right now. While these companies are winning, others like Cochlear and CSL are having a shocker as high energy costs drag down the broader economy. Cochlear actually crashed 40% on Wednesday after a massive profit downgrade, showing just how brutal this market can be. But let's refocus on our favourite yellow metal, because gold is caught in a fascinating tug-of-war between safety and interest rates. As of April 23rd, spot gold is trading around $4,726 per ounce. This is a proper golden entry area for some, but others are worried that the safe haven trade is losing its shine due to the dollar. Gold has lost about 10% of its value since the conflict started, because higher inflation is forcing central banks to stay hawkish. Usually, war makes gold fly, but in 2026, the oil-driven inflation is making traders fear that the Fed will raise interest rates even higher. Higher rates make non-yielding gold less attractive than US Treasury bonds, which are currently paying some very tasty yields. The US dollar index, or DXY, is sitting around 98.6, holding strong as investors repatriate their cash for safety. We are seeing a safe haven paradox, where the same crisis that should boost gold is actually pushing the dollar and bond yields up. However, JP Morgan is still calling for gold to hit $5,055 by the end of the year. They reckon central bank demand is so strong that the gold price has established a formidable floor that the bears can't break. China and other emerging markets are still aggressively adding to their gold reserves to diversify away from the US dollar system. This de-dollarization trend is a slow burn, but it provides a massive structural support for gold in the long-term outlook. Even with the recent 20% correction from the January highs, the long-term bull cycle for gold is still very much intact. Traders are closely watching the Federal Reserve, as a potential rate cut later this year would be the rocket fuel gold needs to fly. But for now, the gold market is suspended in a narrow range, waiting for the next big headline to decide the next major direction. Let's optimize this entry by looking at the technical indicators on the 1-hour and daily charts for the 22nd and 23rd. On the intraday charts, we have seen a death cross formation where the 50-period EMA has crossed below the 200-period EMA. This technical signal usually points to more downward pressure in the short term, which is why gold has been struggling to sustain a rally. The 50-period exponential moving average is sitting at $4,754. Meanwhile, the longer-term 200-period EMA is slightly higher at $4,782. The Relative Strength Index, or RSI, is currently hovering around 57, which is pretty neutral but tilting toward the bears. For the bulls to take control, they really need to reclaim the resistance level at $4,771. If we can close a daily candle above that mark, the next target for the gold getters is $4,835. On the downside, the bears are trying to sink their claws into the support level at $4,708. If that floor breaks, we could see a quick slide down toward 4,647 or even 4,500. On the daily chart, things look a bit more constructive, as the price is holding above the 100-day SMA at 4,700. This 100-day moving average is acting as a pivotal layer of trend support that has been defended multiple times this week. The 200-day SMA is way down at $4,236, which is the ultimate safety net for this trend. Momentum indicators are aiming marginally lower, which suggests that the bullish pressure is moderating rather than accelerating right now. We are basically in a wait-and-see mode until the next round of US inflation data or a major update from the Persian Gulf lands. It is important to keep your position sizes reasonable, because the headline risk in this environment is off the charts, mate. One tweet or newsflash about a ship being seized can move the gold price $50 in either direction in just a few minutes. Gold getters should also keep an eye on the US crude oil inventory data, as it is a major catalyst for the whole commodity complex. High oil inventories would be a relief for the markets, but a surprise drop would send oil and inflation fears back into the stratosphere. The interaction between WTI, oil, and gold is the most important relationship in your portfolio right now, so watch it closely. If you see oil start to dip, gold might actually rally as the pressure for the Fed to hike interest rates begins to ease off. In Sydney, we are seeing the Aussie dollar hold its ground at around 72 US cents, which is helping our local miners too. The resources strength on the ASX is one of the few bright spots in an otherwise gloomy week for the broader Australian market. Metals like copper are also hitting record highs near $6 per pound, driven by the same energy and infrastructure themes we've discussed. Big money is starting to rotate out of tech and into these hard commodities because you can't build an AI data center without copper and power. Even the magnificent 7 tech stocks like Microsoft and Nvidia have been having a bit of a wobbler this year as valuations get tested. This rotation toward value and energy is exactly why companies like Ampol and AGL are seeing such strong institutional support. If the war persists for years, the entire global supply chain will have to be rebuilt with a focus on local and allied production. That means our local ASX, energy and materials sectors could be looking at a multi-year bull run that is only just getting started. We have to be prepared for the stagflation alert, where growth slows down but prices keep going up because of the energy shock. In that scenario, gold eventually wins, because it is the ultimate hedge against currency debasement and government overspending. Think about it. The US debt is now over $40 trillion, and they are spending more on interest than they are on their military. That is not a sustainable system, and eventually, the smart money always finds its way back to the safety of physical gold and hard assets. We are seeing central banks in Malaysia and South Korea join the gold buying spree, which shows the demand is spreading globally. Even if the safe haven role of gold is being tested right now, the fundamentals of supply and demand for oil and gold have never been clearer. We are in a structural deficit for both energy and sound money, and that is a recipe for massive volatility and opportunity. Traders who can stay calm and stick to their technical levels are the ones who are going to come out on top during this reset. Don't let the noise of the headlines distract you from the reality of the charts and the massive shifts in global energy flows. Remember that every dip in a quality asset like gold is just more room in the pouch for the long-term gold getters. We have covered a lot today, from the 17 million barrels of oil stuck in Hormuz to the death cross on the gold charts. The timeline for bringing oil capacity back online is looking long, which means those high energy prices are likely here to stay. This keeps the pressure on the Fed and keeps the gold price in this tense, range-bound battle for the time being. But the smart money knows that when the dam finally breaks, the move in gold is likely to be violent and very profitable. Keep an eye on that $4,700 level on gold, as it is the line in the sand for the current bull trend. And don't forget to watch ALD and AGL on the ASX if you want to play the energy security theme right here in Australia. The market's having a bit of a wobbler, but that's exactly when the best opportunities are born for those who are paying attention. To recap our main points, oil is the king of the market right now, with WTI swinging wildly as the blockade in Hormuz continues. 17 million barrels of oil are trapped, and the damage to infrastructure means supply won't recover quickly, even if peace is found. This energy shock is fueling inflation and keeping gold's price capped as the market fears higher for longer interest rates from the Fed. On the ASX, energy stocks like Ampol and AGL are the standout winners as Australia moves to secure its own power and fuel supplies. Gold is currently trading around $4,726 and facing bearish technicals. Resistance for gold is at $4,771, while key support sits at $4,708. The long-term outlook for gold remains bullish due to central bank buying and the persistent trend of de-dollarization across the globe. However, short-term volatility will stay high as long as the Middle East conflict remains a binary event for the global financial markets. Smart money should stay nimble and keep an eye on those moving averages to optimize their entries and protect their hard-earned gains. Now, I want to hear from the Gain Squad, what is your plan if oil stays above $100 for the rest of the year? Do you reckon gold is still the best place to hide, or are you moving your cash into ASX energy producers instead? Leave a comment below with your big question for the next few months, and let's get a proper debate going in the comments section. If you enjoyed this update, please smash that like button and subscribe to Goldie Gains for more professional market analysis with an Aussie twist. Your support helps us keep the channel running and keeps the Gain Squad ahead of the institutional pack. Keep your positions tight and gains golden. I'll see you at the next close. Cheers!